Good morning, traders. Today is the 1st of November. My name is Neville Hornsey, market analyst for YouTrading, and today I'll be joined by
Joel Frank, also market analyst for YouTrading.
How you doing, Joel?
I'm all right, Nev. Had a pretty chilled weekend, to be honest. Didn't get any costumes or anything, which is maybe I should have done. I don't know. What about you? How was your weekend?
Halloween capped the end of a week away from home. We went away, spent some time with the family for half term. So yeah, Halloween was a good book ending to that. So yeah, it was fun times.
Nice.
We were just saying, we've got a busy week ahead, and
yeah, we do.
What do you think is going to happen roughly as an overview?
Oh God, what do I think is going to happen? I wish I knew. I wish I did have that crystal ball, because I'd be so rich if I had that crystal ball. But there's a lot going on. I mean, the main focus is the three big central banks: Fed, Bank of England, and RBA. But then we've also got US jobs data, which, as we know, is very important every single month, as it's a key sort of input into future Fed policy decisions. And then we've also got US ISM PMI data, which is a good lead indicator as how their economy's doing. So those are the main things this week. But then we got a few other things to be juggling as well.
I'm just going to quickly share the screen on the computer. So yeah, just looking at the YouTrading.com heat map here, we can see that the Forex map is mixed, but the euro is doing really well today, and so is the New Zealand dollar. And so far, the yen is the weakest. And I guess we just had the elections in Japan, and we see that the dollar yen is rising, and we've got the Nikkei also rising. So I guess weaker yen, bullish stocks for Japan. Anything else to add to the whole election?
I think, we had a positive surprise. For most investors, saw it as a positive surprise. The LDP party, which is current Prime Minister Kishida's party, they're always the dominant party. They lost some seats but maintained their majority. There were some worries that they were going to lose their majority in the lower house, which was going to basically cause a bit of a political ruckus and create some uncertainty about future fiscal policy and stuff. But that uncertainty now has just basically been removed pretty much. So we can expect some more fiscal stimulus in Japan before the year end.
Yeah.
It's given Japanese stocks a bit of a boost. Obviously, safe haven yen doesn't respond too well to that. So that's what we're seeing, I think, this morning.
No worries. So all good there. Next big one, I guess, is going to be the RBA.
Yes, in terms of the chronological order of things this week, definitely RBA.
Aussie dollar has been rising back up to the breakdown level of the head and shoulders pattern that I described back in June. And now we're going to come up and test the neckline. So Aussie's been doing really well on the back of commodities. Obviously, they were going up, even though some are coming down again now. US dollar's been sort of held below the $94.50, but the Aussie dollar above the moving averages. And I guess RBA is going to have to get a bit more hawkish, aren't they, at some point?
Yeah, I mean, they're kind of being forced into it, aren't they? They were trying to do this yield target on one of their 3-year bonds. It was the bond which the government needs to pay back in April 2024. Yeah. They were trying to keep the yield on that at 0.1%. Markets have just absolutely blown through that. I haven't seen what the yield is this morning, but it was at 0.7% or something last week. So so basically, I think nobody really knows what's going to happen. Are the RBA going to come back in and defend that target? I personally don't think they will, because it's been absolutely destroyed. I don't know how you can defend it after it's been that badly destroyed. So in the meeting this week, they're probably going to say that basically admit defeat with their yield curve control. But then probably more importantly, I mean, that will be important for the Aussie and could be hawkish and boost the Aussie. But the other thing is they've also got this very, very dovish guidance on interest rate hikes. They're saying that they're not going to hike until 2024. If they tweak that a little bit, that would be interesting, because market's currently pricing in hikes next year from the RBA. So do they start to endorse that market pricing? Do they stay super dovish? Yeah, it's going to be an interesting one for the Aussie. Definitely.
So I think this is like a massive lesson for everybody, like just in terms of it's so obvious when it happens that the central banks follow the bond market, even though they're supposed to be like leading the way, the central banks. I absolutely believe it's the bond market will lead and the central banks will follow, and they just adjust to whatever the market's already priced in. It's just, and also like when something's pegged, you know, like this yield control, curve control, or a pegged forex pair, the peg always, gives way at some point, like we saw in the Euro Swissy at that time. Every time it happens, there's always like a big move when it breaks through. So I just think the markets lead the way and pegs just don't work.
That is actually a really good point. Because like I think in past decades, there's always been this idea of bond market vigilantes. Have you heard of that term before?
Yeah.
Where bond markets punish governments where they think their fiscal spending plans are unsustainable, so they punish them with higher borrowing costs. Or if they think the central bank policy is incorrect, like we've seen with the RBA, then they punish them by pushing things in another direction.
Yeah.
But there was a bit of a sense that, like, in the last sort of decade, we've had these unconventional massive QE programs in a lot of these countries, and the QE, a lot of people said that the QE murdered the bond vigilantes, because like it meant that bond vigilantes couldn't win, because no matter how many bonds they tried to sell, the central banks would always be in there just buying and buying and buying them.
Yeah, definitely.
But then again, like, well, there's that. But then again, perhaps this is a bit of a reminder that the central banks aren't invincible against the bond vigilantes, and eventually they have to accept reality. So it's interesting, isn't it?
But also, like, I mean, just I don't want to like hold on the RBA for too long, because we've got bigger things to talk about. But
True.
RBA were talking about tapering, and then they stopped tapering. The whole COVID thing hasn't destroyed the Australian economy yet. So at some point, as we've seen inflation around the world rising, these bond markets are saying, look, you're going to have to like raise your rates, like all the other central banks are going to raise their rates. We might as well just moved on to, because there are going to be some banks probably raising rates this week, and if they don't, it's going to be a bit of a turn in the market, I reckon.
The Fed is up next on the Wednesday. This is, it's probably the most important Fed meeting of the year so far, because we're going to actually see a policy change. They've flagged it for months and months now, but they're going to advance their QE tapering plans, which, we want to see how quickly do they reduce, because at the moment they're buying 120 billion worth of bonds per month. How quickly to bring that to zero? Markets are expecting them to reduce that by 15 billion per month. So I think that would mean they'd be done before June. But they could do it quicker than that. They could be done by April, which would be a little bit hawkish. And then obviously, probably more importantly than the QE taper, is how they sort of guide expectations for future rate hikes. That's been a big theme recently. So those are the things to be looking out for.
Yeah, so like they said, like most central banks have said, that they're not going to raise rates until the taper is done. But it doesn't mean that they won't. And they've also reminded the markets that, yes, they're reducing the amount of sort of pandemic purchases, the extra bits, but they're still going to be purchasing, like they're still removing like bonds out of the market still. They are still doing QE. It's just they're going to not do as much. So there's going to be a lack of issuance of the sort of bonds. There's going to still be QE, and then there might be like a quicker rate hike coming, because like you say, if they do finish the taper by spring, early summer, then that allows them to do the rate hike straight away.
Yes, exactly. So that'll be one of the ways that markets will read this situation. If they announce a much more aggressive taper that ends sooner, then markets will probably interpret that as saying, okay, so the Fed wants to end this taper more quickly to give them more room for rate hikes sooner. And that's despite the fact that the Fed has tried to like de-link the two. They've been saying, the end to our taper doesn't mean we're going to start hiking rates. Well, nobody believes that. So,
but also, like the TLT, obviously, did like a sideways move between July and September, early October. And now we've just got back above like a significant line, the 145 on this chart here. You know, if they do raise rates, or the market really expects them to raise rates, then the TLT and bonds will come down. And at the moment, we're not seeing that happen. We've just seen like the sort of the notes, the like 2-year notes, 3-year notes rising to meet the 10-year notes. And basically they're flattening the curve. But the longer term bonds aren't seeing a rate hike anytime soon.
Yeah, I think one of the things with that is that reflects the fact that markets, they might expect rate hikes to come sooner, but that doesn't mean they expect in 5 years' time, say, or even 3 years' time, rate hikes to be higher. Actually, it's looked as though, like, so you call that the terminal interest rate, like the point where, so you central banks hiking rates, and then they stop, and that's the terminal interest rate. And it actually seems as though the terminal expectations for the terminal interest rate have actually come down in recent weeks. So expectations for rate hikes, like the closest ones have been brought forward, but the terminal interest rate's been pushed down. So we've seen this weird flattening in the curves, in the yield curves as a result, like you're saying. Yeah. But, you know, if we start pricing a higher terminal rate, then that is when these longer term bonds will just get absolutely down. Smashed.
Yeah. All right, cool. All right. Yeah. So next is probably a 15 basis point rate hike for the Bank of England, do you think? Or do you think it's going to be more?
You know, I think maybe it's not a coin flip. Like, it seems likely that they're going to do it. I was reading this, I can't remember what it might have been in Bloomberg this morning, but it was an article talking about how the MPC, the Monetary Policy Committee that vote on Bank of England interest rates, they seem quite split. There's the hawkish guys like the governor, the chief economist, but then there's also a couple of doves. And then there's like two people in the middle, and they haven't really indicated what side of the argument they fall on yet. It probably seems that they'll go with the governor, who's more hawkish than the dovish members. But yeah, I don't know. But this is the thing. This makes for such a great two-way potential reaction for GBP.
Yeah,
we don't know if they're going to hike rates yet.
At the moment, the market's saying no, I guess, because the pound's come off some recent highs. But this central bank stuff has been like widely flagged as being, you know, probable going to happen. So a lot of this is going to be priced in. So I guess if they do something more aggressive, like any of these banks do anything more aggressive, then we're going to see some movement in the upside to the Aussie, the US dollar, or the pound. And if they don't do anything aggressive, it might just stay where it is, like within these ranges. Just
whilst we're on the topic, I just went on the CME Bank of England watch tool, and the probability of a rate hike is seen at 55%. That's the money market pricing, apparently.
That's Thursday. So I personally believe that Wednesday is going to be a big move in the markets, because they've either going to do what the market expects or they're going to surprise the market. So there's going to be something happening.
Just quickly, the other thing on Wednesday, obviously it's jobs data week from the US. We do get ADP, which can be a bit of a market mover as well. And actually in the last couple of months, ADP has been quite a good predictor of the Friday NFP number. So that's another thing to be watching out for. I mean, look at that. Oil's actually popping a little bit higher this morning.
Yeah.
Oil is probably going to remain supported, isn't it?
No, I think so. I think it's a tight market. US dollars not going to do much until we've got all of this US data out of the way, in my opinion. So if the dollar goes down for whatever reason, then oil's going to really go a lot higher. But at the moment, I just think these two assets go sideways for a little bit in their ranges. Yeah, and the big surprise will be OPEC. Adjusts something, either more or less. But that's the surprise. If they don't do anything, then this is just supported by the dollar. All right. All right. So Friday, we mentioned the non-farm payroll. Obviously, we'd like to see like 400,000 new jobs made, but it could be any number. It seems it is quite a random number. But 400,000 would be, pre-pandemic would be amazing. So it'd be good. up from 194 in September. So how do you see things playing out on Friday? Because that's, there's ISM manufacturing and all sorts as well, aren't there?
Yes. I mean, the ISM data is probably going to be pretty decent, because one of the main things that was sort of weighing on US growth in Q3 was elevated COVID infections. That has abated a little bit. Like, infection rates in the US are quite a lot lower now than they were back in Q3. I remember, actually, we had the Q3 GDP data last week, which was quite weak out of the US, but most people expect Q4 to be stronger. And the ISM data this week should sort of feed into that. The jobs data should probably be good as well, because like we've had initial jobless claims that's just been steadily moving lower and lower and lower in recent weeks, which is a good indicator for NFP. And stuff that had potentially been holding back the jobs market, like enhanced unemployment benefits, like kids not being at school. And then I already said, like, elevated COVID infection rates. Those things have sort of eased. Well, I mean, the benefits have stopped and the kids are back at school. So, I mean, that frees up a lot of people. Yeah. So, I mean, it should be pretty decent, I would think.
Yeah, and add on earnings, and we've got rising equity markets. So, everything seems to be pointing towards a bullish market, unless there's, like I said before, like some surprises, but I don't think there will be. Yeah,
and that's a good point. Earnings, obviously, we've had all the big tech names now last week, but just keeping an eye on the general gist of earnings is probably going to be important. Like, there's just statistics, like you can see these in Reuters every day. They'll write about this, like the proportion of companies that are beating on expectations. As long as that remains elevated, because I think it has been above 80% of the S&P 500 companies beating expectations. As long as that remains elevated, then that should be supportive.
Yeah. So the S&P's rising on this chart here. We already talked about the UK, but the UK 100 is out of a range, bounced up, classic retest, got back above, made a new high. So that looks like it's going to go and test some decent levels above now. So it does look like equities are going higher. So that's risk on. Yen's coming down. So that's risk on. So unless the markets get surprised by these central banks or, some other key data, I just think it's a trend continuation. What about you?
Yeah, I think you're probably right. I mean, because one of the things that I've been thinking is, in recent weeks, as the inflation risks have risen, we've also seen markets pricing in much more hawkish central banks, from the Fed, Bank of England, you name it. They've all been getting more hawkish market pricing. But despite that, equity markets have been doing really well. So even if we do get hawkish surprises from these central banks this week, maybe that can trigger a bit of profit taken in stocks, but I don't think it's going to trigger a broad panic, as hawkish central banks in the past may have done. I think markets are kind of prepared, and they know the central banks are going to be a bit more hawkish, and they probably think that that's actually appropriate, because maybe equity investors would be more worried if the central banks weren't hawkish, because then they'd be getting worried about runaway inflation. So, that's the way I see it.
Yeah, cool. Is there anything else that you'd want to sort of touch upon?
We've got Canada jobs data as well for the loony traders. I think, and New Zealand jobs data. So New Zealand's on Tuesday, Canada's on Friday alongside NFP. Yeah. So just keep an eye on them if you're trading those pairs, because those will be important for their respective central banks as well.
Yeah, definitely. Yeah, talking about the loonie, I had a trade idea where I was going to go short with this sort of correction, and it started to work, but it hasn't really gone much further. It just looks like it's in this range here. All right, great. Well, I hope you have a great week, and I'll catch you next week.
Thanks, Nev. Yeah, speak next week, mate. Have a good one.